Gold has had a wild ride over the past few weeks, surging nearly 15% from its July lows to touch about $4,700 an ounce, just shy of the record territory, before taking a quick breather on a hotter US inflation print. But if you're looking at gold through the traditional lens of real yields and interest rates, you're missing the bigger story. Gold is currently decoupling from classic macro playbooks. So what is really driving the move right now? Now, if you're asking what's the immediate trigger, a surprise move from the US Treasury. Treasury Secretary Scott Bessent announced a major ramp-up in buybacks of long-dated government debt, with hints that the program could expand even further. The results? Yields on long bond plummeted and the US dollar softened, and gold tacked about 7% in just 7 trading days following the news. But the Treasury buybacks aren't operating in a vacuum. They tapped straight into a much deeper narrative. Now, the most important thing is that gold is no longer just a safe haven asset for rate cuts. It's trading as a direct hedge against US fiscal credibility. With the US national debt crossing above $40 trillion and structural deficits widening, institutional capital is piling into what is called debasement trade. When you look at the ETF data, gold and Bitcoin ETFs saw a combined record of $7 billion in net flows over just 5 trading sessions, with over $3 billion going into SPDR gold alone. Investors aren't picking between digital and physical assets anymore. They are buying both at the same time to insulate against debt monetization and policy volatility post-Iran war tensions. We are even seeing ultra-high net worth funds explicitly rotating out of traditional bond allocations into physical gold. What could derail or fuel the next rally? First, the Fed Chair Kevin Warsh's upcoming speech at the Jackson Hole. With inflation running hotter than expected, markets are weighing the risk of another rate hike, which briefly boosted the dollar and pulled gold off its 4,700 high. Second, geopolitics. The ongoing standoff in the Strait of Hormuz keeps the permanent risk premium embedded not just in crude oil, but across the entire commodities complex. Between Treasury liquidity interventions, geopolitical risks, and record ETFs accumulations, gold structural bid remains firmly intact. Now, the speculation positioning rebuilding and major institution eyeing $5,000 an ounce before the year end, all eyes now turns to the Fed for the next major signal. Subscribe for more institutional macro breakdowns and let us know also in the comments below. Do you think that gold will hit $5,000 again this year? Thank you for watching, and I'll see you again in the next video.